All right, so imagine, if you will, that you were looking at price and those relative equal highs right here that we're looking at conceptually. We would anticipate a run above that. Now, if you can get that far in your understanding from what I've taught, you have the beginning building blocks of understanding how to look for a market maker sell model. But I want to flesh this out a little bit, because it's not just simply understanding where relative equal highs and relative equal lows are. You have to understand what the market's trying to do and gravitate to. And for the premise of doing it to go higher, longer term, or to go up just to trick people into being long and then going lower longer term. That's narrative. Now I'm using a close line chart. So it's going to be a rather crude depiction of a general idea. Okay, we'll transition to actual charts in a moment, but for now, I want you to just think conceptually how if the market's going to run eventually up above that, and if we could hold a bearish stance, meaning that we look at every rally as a suspect rally if we're bearish, and then we're going to be looking for some measure of reversal, and then once that reversal is qualified, that meets the criteria for a market maker sell model, then we can go in and engage it. Now, an advanced interpretation of this would be anticipating the run above these relative equal highs here and being long prior to it. And the most advanced form of it would be to buy it during the buy side of the curve and then short it during the sell side of the curve. That is very advanced. And while I do have students that can do that like me, not many of them can. They can either trade the long side of the buy side of the curve, or they can sell short on the sell side of the curve. So it's a matter of them picking what they can see clearly based on their present understanding and their experience. And don't try to rush it. Don't try to keep up with me. Don't try to keep up with my other students that are doing well. It's at your own pace that you learn this. That's the best pace to learn it at. So don't try to feel like you're behind or you're trying to catch up with the class, because I have students that go back to 1996. So you're never going to catch up to them. So I want you to take a look at that price movement here. If this is a market that you'd be trading or interested in learning, these ideas are universal. So it's not a matter of it only applies to futures or only applies to index futures or Forex. It's universal. Okay, so as long as there's a price feed attached to it and it can be traded, these conceptual ideas can be applied to it. Okay, this whole idea from this run up to that level there, this is what I refer to as buy side delivery. Okay, so when price is running higher, it's offering buy side. It's giving the marketplace buy side as it's running higher. Now, for the purposes of running above this high and this high, it's running up to engage the liquidity that would be resting above these relative equal highs. So the distinction here is the directional movement when it's going higher, prices in a buy side delivery. Liquidity above a single or a group of highs, that is buy side liquidity. That's orders that are pending, whether to be a buyer to break out and go long or to protect a short position. So liquidity is a stagnant price level or levels where stops would reside. Buy side delivery is the actual animated movement of price moving higher. And as you probably would have guessed, when we're looking at price going lower, this here is what I refer to as sell side delivery. So the express purposes of running above these relative equal highs, that function has been performed. So now price could, if we're bearish, move lower and then trade back below the previous rally low. So it's buy side delivery to the upside to engage liquidity, trap traders long, and smart money would go short here and ride it back down to stop out any individuals that were lucky enough to be long in this but kept a stop loss here or inside this run up during the buy side delivery. Their stop loss would be tagged out. And again, with the premise of reaching for the new engineered sell-side liquidity, which would be the sell stops on longs that anyone would have been going long here, their stop loss would be priced right below here. So it's the rally up to take buy side and then rip right back down to take the sell side on those individuals that were trying to go long and weren't astute enough to reverse or, at the very minimum, close out in a profitable position. Now, as I promised, we're going to look at it through the lens of open, high, low, close candlesticks. So take a couple minutes, look at this before I continue. Pause the video before I start talking and make observations about what you think you see here, what's salient to you. And when you're ready, unpause the video. All right. So what we're looking at here is basically the same idea of price action. Instead of a line close chart where every fluctuation is only noted by where the interval will be utilizing that closing price only, not the highest high and the lowest low, but the closing price. Here we're looking at the highest high and lowest low and the open and close of every individual candlestick of this respective time frame. So we see the relative equal highs here with this high and this high here, and the market rallies up here. So all of this is the buy side delivery and a subsequent sell side delivery, attacking the sell side that was created after the run higher. And this run higher attacks the relative equal highs here where liquidity is. So markets go up for two primary reasons. One, it goes up to engage buy stops, which is buy side liquidity. Or it goes up to an inefficiency. What is that? Well, if you look right here, that's an inefficiency. We have this small little segment of price action where the previous candle's low stops here. The next candle opens, trades up a little bit, goes lower. The next candle we open, trade up, stop here, and then we move lower. This separation between these three candles here, one candle in the middle, this is what I call a fair value gap. It's a very specific price level that we look for, and it's one of the most visual things that you can see from my repertoire and the things I teach. Your eye should jump right to it when you see it. And in this case, if you've missed it, you can see clearly now it's highlighted. So because it's a down closed candle, what kind of inefficiency is it? A fair value gap classified as a SIBI, S-I-B-I, sell side imbalance, buy side inefficiency. Meaning when these form, the market's algorithm that produces the fluctuations in price, not because it's buying and selling pressure, but the market rallies to these predetermined levels because it has to offer what? Here, this one single candle went lower. So what does it need to do if it's going to be an efficient market? It needs to trade up, back in between these two price points. This candle's low, this candle's high. We see that here. This candle trades up to it, but where does the close stop? Right at the high of it. The next candle, we open and we trade back down. Yes, there was a small wick here. Yes, there was a small little wick here. That is acceptable. That's permissible. But the bodies tell us the narrative. So all of this rally up here was under the pretense that we would see it just simply trade back to this little area here, above the buy side, above this high and this high. So ICT, how far can it go above these relative equal highs? You'd have to look to see if there's any close proximity inefficiencies. In this case, we have one right here. Notice this candle's tail goes way lower. Then we open, trade back up, making the low of the fair value gap. And then we trade here lower. Then the next candle we open went lower. So all of these three candles here, we've had a lot of back and forth price action. There's no fair value gap here. We can clearly see there's a gap because there's only one candle making that defined range of that low of that candle and that candle's high. So that small little area here is a fair value gap. The algorithm will go back to that and reprice to it. How? By going back up to it and offering a patch, filling in this only one singular down close candle. Now we have an up close candle laying directly right over top of it. So it patches over the inefficiency here in price. So right away, you can see while this discussion is primarily market maker models. To understand what my market maker model is, you have to understand a plethora of other supporting studies. So let's go into greater detail here how the market ran up into this area here. Let's focus on how it went down, not just simply below the sell side of that original rally up, but it went down to this old low right here. Look real close, you'll see that it went just below that. That's not random. This right here is a buy side imbalance, sell side inefficiency. It's the opposite of this singular candle here. It's an up close candle. So it wouldn't be a SIBI, it would be a BISI, buy side imbalance, sell side inefficiency. So it digs into this just by a little bit, but specifically right below that low. Again, that's not random. These are things that I like to look for. You can also see how we had that same thing occurring here. This is a buy side imbalance, sell side inefficiency. Again, the opposite of this. Up close candles that create a fair value gap or inefficiency is referred to as a BISI. The classification by PD array is fair value gap, but it's an up close candle, so it's a buy side imbalance, sell side inefficiency, meaning the price will want to go back down to it eventually. And in here we have that imbalance, and it trades where? Down. Once it gets into there, it reprices to the order block, then it rallies back up, creating the initial stage of what? A shift in market structure above this high here. So now we can look for a retracement back down in. So as it's retracing, we're anticipating the price doing what? Eventually reaching for the high here and here. So we can look for a lower time frame to give us a scenario where if we think it's going to go above these relative equal highs, and we can see that this fair value gap wasn't hiding, it's in plain view. It should stand out on your chart. That's why you're encouraged by me to annotate them when you see them. So if you see a draw on liquidity that's setting up above or below the marketplace, don't just limit your focus to that. Look in close proximity just above these buy side liquidity highs here that are relatively equal. How far can it go above it? Well, looking over here, there's no inefficiency here, but there is one right there. So how far can it go above these relative equal highs? There. And look where the bodies stop. Okay, so that's not random. All right, so we're going to zoom in here a little bit. Drop down into a lower time frame chart here. And don't worry, I'll let you know what this is as we get to the close of the lecture, but just stick to what I'm showing you here. We have the low, buy side delivery, trading up into the fair value gap that was on a time frame that was 60 minutes, but now we're on a 15-minute. So this time frame here is a 15-minute time frame. It's 1/4 of what was shown as the previous chart. So there's 4 times the number of candles. And I've given you a reference point that it was based on a 60-minute or hourly fair value gap in the form of a SIBI, sell side imbalance, buy side inefficiency. And still you can see the bodies respecting, and only the candlestick's wicks are piercing it. See that? So that's very, very indicative of qualifying the fact that we went up to a specific level, and therefore we can trust that the algorithm is kind of like broadcasting to those that know how to look at it and see it, that it's likely to now reprice lower. Reprice to where? Below this low. And any accelerated run below this low, how far can it go? Is there any inefficiencies over here? Don't look at this one because that's above that low. We would already be anticipating a retracement back below that. Where will we look? The rejection block, which is the lowest down close. And then we have these relative equal lows here. And you can see it just goes a little bit below that low right there. We're going to get into this in a moment. For now, just notice that we have ran above that buy side, that old high here, that old high here. Shift in market structure on the hourly chart above this high here. So it's retracing. What's it retracing back down into? The fair value gap, order block, right there. So now, does the market offer consolidation? That's what we would be expecting here. Is it consolidating? Is it offering a small little pause in price where it goes sideways for a little while, which would be accumulating long positions. That's allowing smart money to accumulate longs. I'm going to zoom in. This is the same time frame, okay? So it's 15 minutes. Here's that low. You can see how we just went below it right here. See that? Here's that low inside the fair value gap with the order block, which is a down closed candle. Again, we would be anticipating some measure of consolidation, not dropping lower, consolidation. Because that means we would be anticipating a run above the buy side here and the previous high that's to the left outside the scope of what I'm zoomed in on now, but you can see it's still being highlighted. And then that 60-minute fair value gap in the form of a sell side imbalance, buy side inefficiency, that's here. Okay. So what we're going to do is we're going to drop down to an even lower time frame and see if there's any more detail in here with a 5-minute chart. So now we're inside of a lower time frame, 5-minute chart, and I've highlighted now this little area right down here. I told you we would talk about that. In here, we're looking at a balanced price range. A balanced price range is where the market has both a downside and upside, or sell side delivery and buy side delivery that overlap one another in the same relative range in price. So you can see how this candle's high, that candle's low. That would normally be what? A sell side imbalance, buy side inefficiency. But look what's happened over here. We have a high, a big up close candle, and this candle's low. So what does that make this? A buy side imbalance, sell side inefficiency. So there's an overlapping between a SIBI and a BISI within the general area of the same price range. So I'm using the low here and the high here. So that way we can see how this becomes a balanced price range. These are trapped traders. Okay, this in here is a trap trader, or trap traders that would have been caught short. In the classic days of commodity trading, if you were to see old patterns like what would be considered an island reversal, okay, this is the closest thing that I can kind of use to describe what's occurring when there's a balanced price range, when it's extreme like this. So when we have a big decline, large range candle that's down, and then eventually, not like months later, not weeks later, but when it's a big drop and a handful of candlesticks like this, it's not a whole lot of candles, and eventually, rip back higher. That means that this was someone that's been caught. They're short, and they quickly reprice and leave them down there. So when I see that, I look to see where those two reference points are, where the market drops quickly for sell side delivery, and then when it rallies back up quickly, those one big candles down, one big candles up, all the price action below it, I would view that as trap traders. So that means by itself, that gives me narrative that it's probably going to go higher. So now cue up the idea of what would it be reaching for? Well, we see it was dropping back down into an inefficiency here, the buy side here, and the old high back to the left, and that 60-minute fair value gap, that's a SIBI up here. We're still in a 15-minute time frame, by the way. I miscued it earlier, calling it a 5-minute. See the idea of the market consolidating, that's what we're showing here. Now, how am I referencing this consolidation? This is the part of it that becomes like a knack, okay? You might not have the exact candles framed like this when you see an original consolidation. So when I call an original consolidation, that is where the market is accumulating. So what I did here, I seen these two candles here, and then the body of this one, and the body of this one. So right away my eye jumps to that because it's what? It's a smooth edge. So I want to use that as the high of the original consolidation. What's the low? The lowest low. See how easy that was? So when I'm looking at the original consolidations, I'm looking for a repetitive overlapping or reoccurrence of a level that's being constantly referred back to inside of a consolidation. Now I'm anticipating the market to go higher, to go above the buy side here, and then reach up into this inefficiency up here. So when we can frame the original consolidation properly, then once we leave it, How are we leaving it here? Look at the body right there. Yeah, we had a wick here. We had a wick right there too. But look at the body staying inside that original consolidation. See that? That's characteristic to algorithmic price delivery. It's indicating to individuals that I'm trying to show you that this is the language that traders that use this information, and the algorithms, the high frequency trading algorithms, they highlight these things in price. And so it gets their high frequency trading algorithm in the hunt for long entries. When is it allowed to take the long? That candle right there tells you. So now we can then refer back to the same level here. If it trades back to that level, what's it doing? It's returning back to the original consolidation. That's how I teach my market maker and sell model and buy model. The original consolidation, it can leave it. It doesn't have to touch it, but if it does, that's usually a trade. So this would be your original entry. Okay, so you could go long there, but sometimes it won't offer a return back to the original consolidation. So it might just need a higher order entry and not offer something right at the high of the original consolidation. The market rallies up, trades right into that 60-minute fair value gap SIBI. Bodies tell a narrative. It's not interested in going any higher. Why? Because look at this big candle drop down there. Wonderful. We have an inefficiency here. We have an inefficiency here. Drops aggressively below the original consolidation. Right back to the high of the balanced price range. Right there. Which is also just below that old low right there that make these relative equal lows what? Suspect for sell side. So sell side liquidity resting below there, that's the draw. If it's going to go well beyond the low here, where the original consolidation's sell side liquidity would be resting. So in layman's terms, what we're saying is it's building up a lot of interest to go higher. Then it rips higher, comes back down, gives one more chance. Okay, one more chance. Then takes off, takes above this high here, then reaches up into the inefficiency. Then at that point, does it indicate that it wants to go lower? Because if you're bearish and you're extremely bearish to the degree where you think this is a good entry point, you could sell up here as it does that. And that's a little scary. I understand that. But eventually you get these multiple entries in here where you can go short. We'll look at them in greater detail in a minute. But eventually the idea was to draw back down into this area here. But if it goes below this, how far can it go? There's no inefficiency over here. It's these relative equal lows. And that's where the market drops to. All right, so now we have more candlesticks, and now this is the 5-minute chart. So here's the original consolidation. You see the market does, in fact, drop back down in inversion fair value gap. I don't have it highlighted because it would be too many things on the chart, but for you, that's inversion fair value gap, meaning that usually that would be sell side imbalance, buy side inefficiency. If the market trades back up into it, we would see it trade lower. But if it's an inversion fair value gap, it means it's going to go above it, come back down, and use it as a discount array. And it's inside of the original consolidation and rallies. Takes the buy side, trades the 60-minute fair value gap SIBI. Even on the 5-minute, look at the candlesticks. The bodies are inside that SIBI. It's indicating that, yes, there's wicks going on in here, but that's just the damage, okay, where it's reaching for the best case for smart money to get short against. And then we see it drop lower. Zoomed in on that 5-minute chart. Here we have the original consolidation, the rally up, and I want you to pause the video again. And if you're not doing this, I promise you, you're really not getting the same measure of understanding and the opportunity to see it in your own eyes and test your observations. You might not get it right, but that's okay. Trying and attempting to do it and seeing things with detail, you might not have it exactly right, but what happens if you do have the things I'm going to point out? It's encouraging. So don't rob yourself the opportunity to have that. So pause the video, take a look at all the price run from here up to here, and then down. What do you see? All right, if you haven't paused the video and want to, you better have it paused because I'm about to continue. When you're looking at this, my eye sees this. return to the original consolidation. The market rallies up. We have a down close candle that's just below this area right here. What does this up close candle become? Bullish breaker. Low, high, lower low. Down close candle inside of the breaker candle over here. That's a bullish order block right there. So when it rallies up and trades back down in, our target is what? Up here. The initial draw is the liquidity above that high and the older high to the left. It's not inside this fractal price action anymore, but it's highlighted with this line. So this drop down, that could be, if you're not seeing the original consolidation correctly, and this would be your original entry or your first stage accumulation. And then this would be second stage reaccumulation here, and it rallies up. But if you don't, for the sake of those individuals that wouldn't have it identified correctly in terms of how big the original consolidation is, when it leaves it and it comes back down in, I'm making an allowance for that for this lecture here. So you might not have that skill set in the beginning to see exactly how to define the consolidation. Then if that's the case, then the bullish order block here would be your first stage accumulation for you. Is it wrong to classify it this way? No, it's based on your understanding. They're both correct based on the level of experience and knowing what you're doing. The only distinction is how you may or may not have had the original consolidation mapped out right. So many of you may not have seen this as a return to the original consolidation. You may have seen this as relative equal highs being taken, and now it's going to go lower, not knowing all the other narrative that I've outlined here. So down close candle here in the scope of a bullish price run during buy side delivery, aiming for this area up in here. The down close candle is traded to here. So there's your entry for a first stage accumulation, or it would be second stage reaccumulation if you use this as your first entry. So again, just make sure you understand that. Sometimes you will only have one point of accumulation and not have a return to original consolidation. It might just rip higher, give you one opportunity to go in, and then run real quick to it then. And then after that, bleed lower. So it has a lot of different variances to it, again, which is why I said that you have to understand everything that I teach to be able to be well-versed with trading market maker models. That doesn't mean that you can't see a very generic, plain as day, obvious market maker sell or market maker buy model. When it's in the price action and it's obvious, it's real easy to see it. But the potential for more of them to be there and in your fingertips to be able to reach and see, I can see more setups now, that's going to increase over time. Okay, so just understand that. So what have I said here so far? Well, you have an opportunity to be a long entry here or a long entry there. So there's two setups. Which one of these, without going any further so far, which one of these would make sense for you as a trader right now with your present understanding? Obviously, it's a rhetorical question because I can't obviously get the response from you here. But I want you to think about that because I have some traders that would only be interested in taking this as their entry. And if they never get a return to the original consolidation, they're not long. Others want to see that, then it rallies, and in the next buying opportunity, as long as we don't get to the target up here, they're willing to take this as the first stage accumulation. And that's their entry. And then they ride it up into that target. They may or may not have the ability or interest in trying to go short at that time. Other traders can identify this as the first stage accumulation, maybe not see this one down here, and they see this and they want to wait to see if price rallies up to that point. Then they use this part as their model where they go short and they pyramid in here, here, and wait for the run below here and don't even consider something like down here. Is that wrong? No. I have other students that want to see it do this, then really prove it wants to go lower, and then they'll trade that one right there and then go into that. That's a unicorn.